Hi, my name is Abhijeet Puglia. I'm a qualified chartered accountant and a chartered financial analyst with 18 years of post-qualification experience in treasury, investment and lending side. Here we will talk about construction finance. In this module, we will cover what are the various types of construction finance product and what are the nuances of the product. We will also briefly cover the CF investment process, which is followed by a typical lending institution, and how does a borrower go about availing such loan from the institutions. We will also touch upon the underwriting principles which are followed by the lending institution and the pre and post disbursement operations and compliance process. And at the end of it, we will also talk about how to manage this investment or asset and how does a typical repayment of construction finance loan takes place. So what is construction finance? So construction finance is a debt or a term debt which is availed by a developer from a financial institution to part fund the project expenses of a residential or a commercial project. So what is a debt? So debt is basically nothing but a fixed obligation from a borrower's perspective where he is supposed to pay interest and principal back over a fixed tenor of the loan. What is project expenses? The project expenses of a typical residential project include the cost of the land, the construction expenses, the approval related expenses, the sales and marketing expenses, and the admin expenses of the project. To elaborate further, let's take an example of a residential project which is coming in a particular suburb in Mumbai. If a developer is typically developing a high rise which is upwards of 20-30 floors, the construction expenses ranges from 4,000 rupees per square feet on a sellable area basis to 5,000 rupees on a sellable area. The sales and marketing expenses vary between 4 to 5% of the revenue, and admin expenses also comes at 5 to 6% of the revenue. Who is a developer? So developer is a promoter or a promoter group who is into the real estate development business. Typically, the developer would acquire land and would take approvals and then construct the residential or the commercial building and earn profit from the same. The typical providers of capital in the construction finance market include banks. So for example, banks like ICICI Bank and Axis Bank do provide construction finance loan from the wholesale side of their business. HFC, housing finance companies, also provide construction finance loan. Examples of HFCs include the likes of HDFC Limited and Piramal Capital and Housing Finance. CF loans are also provided by foreign funds with the likes of Goldman Sachs, Apollo, Brookfield, etc. And even what we have seen recently is that government have sponsored a fund by the name Swami, which also provides construction finance or a last mile funding for residential projects. The financial institutions earn interest and upfront fees when they lend the construction finance, and typically the project tenor or the loan tenor varies from 3 to 5 years for such kind of loans. In this section, we will cover briefly an overview of the real estate sector. The real estate sector comprises of 3 broad segments: the residential, the commercial and the retail segment. From an overall perspective, it is important to note that real estate is a growing but a cyclical sector. And there is no doubt it contributes almost 13% of the GDP of the country, and hence it's a growing sector. So from a lender's perspective, each lender would want to be part of the construction finance because that will help them to participate in the growth along with the growth of the sector. There are 3 types of debt financing in the construction finance market. First is a structured debt. Structured debt is a debt which is availed by a developer at the time of acquisition of the loan and prior to the approvals. So from a risk standpoint, this is the riskiest segment of the construction finance loan. The rate of interest typically varies from 16% to 24% per annum on such loans. The second loan is the construction finance loan, which is given typically post the approvals are achieved by the developer. In a typical construction finance loan, even sales are also established, and hence from a lender's perspective, they have certain visibility on the revenue and as well as on the cost side of it. Hence, the pricing of this loan is lower than the structured debt and varies from 10% to 14 to 15%. There is a third segment of the loan, which is an inventory financing. So this financing is given by the lenders against the completed residential flats or offices, and the pricing of these loans are cheaper than the construction finance or the structured debt loan. It varies from 9 to 12% per annum. In this section, we will cover the product nuances of the construction finance. The typical tenure of the construction finance loan varies from 3 to 7 years depending on the stage of the underlying project. If it's an early stage project, the financing varies from 5 years to 7 years. If it's a mid to late stage project, then the financing varies from 3 to 5 years. In terms of the end use, typically, as explained in the earlier section, the end use of construction finance loan is for part funding the project expenses, which include the construction expenses, the sales and marketing expenses, and the approval related expenses of the project. In terms of the disbursement, the typical disbursement happens over the availability period of the loan, and the availability period of the loan varies from 0 to 24 to 36 months. And the disbursement happens linked to the construction and the sales milestones which are agreed between the borrower and the lender. Typical construction cycle is 2 to 4 slabs a month, and as per the business plan, the developer gives a broad timeline by which he expects to complete the superstructure and get the OC or the occupation certificate for the project. Typically, the sales milestones or the collection milestones are dependent on the underlying agreement with the home buyer. We have seen a construction linked payment plan for the home buyer, or there are certain subvention schemes which also work in the market. In a typical construction finance linked or construction linked payment plan, a typical home buyer pays 20% on registration. Up to 80% of the flat consideration is paid basis the superstructure completion. So typically a lender would collect 2 to 5% of the entire consideration on each slab completion, and the balance 20% is paid on the finishing, brickworks and on possession. So this is how a typical construction linked payment works for a home buyer. Given the current status of the market, we are seeing subvention plans also becoming very popular, wherein a 20% upfront payment is made by a home buyer and 60% on say slab completion and 20% on possession. And sometimes we have seen schemes where 20% is paid on upfront and 80% on final possession, because the underlying home buyer does not want to take the risk of completion of the project, and hence they want to make a major payment after the completion of the project. In terms of the product, the entire cash flows from the underlying project, which we spoke about, basically the collections from the home buyers happens through an escrow account. The escrow is nothing but a third party account where the entire collections are routed and all the expenses are made through the escrow account. There is a tripartite escrow agreement which happens between the escrow agent, which is a typical bank, the lender and the borrower. This is very important from perspective of ensuring that there is no leakage which happens during the construction period. The escrow arrangement also helps the lender to ensure that the end use for which the construction finance is given, the actual usage of the money also happens as per the stipulated end use, and hence escrow arrangements are fundamental to entire construction finance lending business. In terms of the typical security package of such loans, the lenders take the mortgage of the underlying land, they take the hypothecation of the cash flows or from the underlying receivables, and also the corporate guarantee from the holding company or the personal guarantees of the promoters. Just to elaborate the security structure in further detail, so when a typical borrower or a developer comes to a lending institution to borrow, he will give the mortgage of the underlying land as a hard security to the lender, So typically there are two kinds of mortgages which happen. One is a registered mortgage, another is equitable mortgage. Registered mortgage is what is prevalent in Maharashtra, and equitable mortgage is a more popular mode in southern states. Equitable mortgage is a way of mortgage wherein the mortgage happens through the delivery of the underlying title documents. In terms of hypothecation of the receivables, the way it works is there is a hypothecation agreement which happens between the borrower and the lender, and all the cash flows from the underlying project is routed to the escrow account, and the lender has a charge on these cash flows. As explained earlier, the lender also typically asks the corporate guarantee from the holding company of the borrower, and also take personal guarantees of all the promoters. The typical security documents also include, or the security structure also includes, post-dated checks from the borrower and pledge of the shares of the underlying special purpose vehicle or a subsidiary which is developing the project. In a typical real estate project, the developer develops the project under a separate subsidiary, such that from a lender's perspective, the cash flows and the security package is ring-fenced from an IBC perspective or from an insolvency perspective. There are certain condition precedents which needs to be fulfilled by a typical borrower when they avail construction finance loan. The typical condition precedents of construction finance loan include the KYC, the completion of the Know Your Customer norms, the CIBIL check which is done on the promoters and the borrower company, the completion of entire security documents and the loan agreement, or there could be certain other stipulated sales, collections or construction milestones which could be prescribed before the first disbursement takes place. The conditions subsequent are conditions relating to perfection of the security, including filing of the charge in the Companies Act, under the Companies Act. The conditions subsequent also include the monitoring of the milestones related to sales, collections and the OC of the project. Typically in a housing finance company, the lending book constitutes of 70 to 90% of individual home loans and 10 to 30% of developer finance. A home buyer who is looking to buy a property goes to a home seller who can be a developer or reseller. To buy the property, he goes to a lender to avail a housing loan and pays the consideration in installments basis the construction progress. The overpayment is then utilized by the developer to repay the construction finance loan that he has availed to construct the property.